If you love Rearview Mirror Chronicles podcast and want to help us keep bringing you the most brilliant episodes, then please share it with a friend or a fellow history fan who you think might enjoy it. Thanks for your support, and I do hope you enjoy this episode. Hello, I'm Keith Hockton. Today's podcast is on banking collapses and what I think about them, the history of them, and more importantly, how I think they can be avoided. One of the earliest banking collapses was in AD 33 during the reign of the Roman Emperor Tiberius. That crisis was caused by a credit crunch when effectively the government demanded repayment of loans, which led to a financial panic. Wealthy Roman senators and merchants unable to pay back debts caused a cascading failure of money lenders. However, in the modern banking system, the first major banking collapse is pretty much attributed to the 1720 South Sea bubble in Britain, where speculation on the South Sea Company shares led to a massive bank failure. The most recent and significant banking collapse actually occurred during the 2023 banking crisis when several US and international banks failed, and they included the Silicon Valley Bank, or SVB, Signature Bank, and First Republic Bank. And these failures, they're all triggered by rising interest rates, poor risk management, and effectively depositor panic. So in another life, I was an investment banker, but I eventually saw the light. So I understand that murky, dark, smelly world rather well. And off the bat, I have to tell you that banks are not as complicated as bankers make them out to be. They're just not. And most of what banks do is smoke and mirrors, effectively so that banks can charge you more. The world of interest rates, which can include swaps, swaptions, caps, collars, foreign exchange options, liquidity management, hedging strategies, risk management solutions, they're all designed to help you. That's true. But that's actually the secondary concern. The primary reason is that they are there so that the bank can actually make more money from you. As an example, Goldman Sachs helped raise $6.5 billion between 2012 and 2013 for the Malaysian Fund, formerly known as One Malaysia Development Berhad, or 1MBD. Goldman Sachs didn't do it because they thought that would help that particular institution. They did it for the fees. And on that one particular deal, they made just over $600 million. Just let that sink in, folks. $600 million. So I started life in banking, trading Eurobonds, and I then moved to fixed income and finally to trading foreign exchange for Swiss Bank Corporation, who ended up merging with UBS, I think in about 1999, to effectively become one of the most powerful banks of the century. When I was in banking, I developed and traded options that our back office, our policing office, effectively had never heard of. And frankly, they couldn't understand. And it should never have been allowed. In fact, those guys were coming out to me to ask me how these things worked. Thankfully, those days have changed and regulations are way, way more stringent. But where I'm going with this, folks, is that I understand banks. I mentioned earlier that 3 banks collapsed in 2023, but get this. Between 2001 and 2023, there were 564 bank collapses. Isn't that an astounding figure? However, the biggest banking collapse actually happened in 2008. So picture this. It's a Monday morning, September the 15th, 2008. You're in downtown Manhattan, walking past the towering headquarters of Lehman Brothers. Normally, it's just another day on Wall Street, but today, something's different. There's crowds of stunned employees filing out of the building, clutching cardboard boxes filled with personal belongings. Literally, just hours earlier, the unthinkable had happened. Lehman Brothers, one of the biggest and oldest investment banks in the world, had collapsed. And with it, the entire global economy teetered on the edge of disaster. And as I talk about this now, it's actually giving me goosebumps. Lehman wasn't just another bank. It had actually been around since 1850, and it had survived wars, recessions, numerous financial panics. But in the years leading up to 2008, greed had taken over. The bank had been making risky bets in the housing market, snapping up mortgage-backed securities like they were effectively free money. They were essentially bundles of home loans, many of them given to, honestly, people who could barely afford them. On paper, it looked like a golden opportunity until it wasn't. And that's always the case in banking. And of course, when the housing bubble popped, those securities became toxic and Lehman found itself drowning in bad debt. I remember that weekend, and leading up to that fateful Monday, government officials and banking executives literally scrambled to find a way to save the bank. Other firms had been bailed out. Bear Stearns, another old firm, Fannie Mae, Freddie Mac. But this time, the US government refused to step in. And when no private buyers were willing to take on Lehman's mess, the inevitable happened. At exactly 1:45 on September the 15th, Lehman Brothers officially filed for bankruptcy. And the numbers were absolutely staggering. Over $600 billion in assets vanished overnight, making it the largest bankruptcy in US history. The markets panicked, stocks plummeted, and banks effectively stopped trusting each other. And literally within weeks, what had been a crisis in the housing market turned into a full-blown global financial meltdown. Trillions of dollars were wiped out. Trillions. Millions of jobs disappeared. And the world was plunged into one of the worst economic crises since the Great Depression of 1929. And I think perhaps the most striking image of it all, the sight of those Wall Street bankers, and many of them had once been millionaires, walking out of Lehman's headquarters that morning, their careers, their wealth, their futures reduced to whatever they could carry in a single cardboard box. I mean, the collapse of Lehman Brothers wasn't just the fall of a bank. It was the moment that I think the world realized the financial system wasn't as invincible as they thought it was. And the aftershocks, crikey, well, we're still feeling them today. So what is a bank and why do people need banks? Why don't we just put our money in a huge metal box with a lock on it, or put it in a mattress and just sleep on it at night? So banks actually have a vital function in the economy. So the purpose of banks, the banking system, and the wider financial system is to turn your savings in the economy into investments. So the problem with putting your money, say, under your mattress or in a safety deposit box, or going to Gringotts and putting it in the vault, is that that's not really an investment. That's just squirreling it away in a way that doesn't aid productive investments. And I have to say, there's a generational thing here too. My dad was a classic, of that generation where he didn't trust banks. And he had money squirreled away everywhere, behind the bathtub, under floorboards, in, secret compartments in wardrobes. It was staggering. So what a bank does, what the banking system does, the wider financial system does, is turn those savings of yours into investments. So the bank takes deposits from savers, and it lends that, or it invests that in, say, businesses that invest to build a factory or an office. And those factories and offices employ people. Those firms employ lots of people. And that's how you get economic growth. Investment helps produce economic growth. So a poorly working banking system is actually vital to getting economic growth in an economy. And this is where we have the idea of the ratio between money that banks actually don't have in their basement and then the money that they loan out. So what is that ratio? And is that why banks collapse? Because the money that they've got written in their spreadsheet, I guarantee you, is not in their account at any given time. So a bank doesn't work by having all the deposits it's taken sitting in a safe in, the back of a room with an army of people guarding it. That's not how it works. They work in that they lend a lot of that money out. And what that ratio is changes over time. One of the causes of the 2008 crisis was that the banks didn't have that much in terms of equity buffers. And that's effectively what they owe to depositors against their assets. and the remainder is equity owned by the shareholders. And if that buffer gets too little, it means that the assets owned by the bank suddenly fall sharply, and that bank is insolvent quite quickly. So the banks actually need to have a liquid reserve, so a certain amount of ready available cash to meet demands from depositors to withdraw money from the bank. They also need to have an equity buffer owned by the shareholders, which ensures that if the value of their assets fall, they don't become insolvent. They don't go bust. So those two things are very important, but they're not the only thing that the banks need to keep an eye on in order to remain stable. So when times are good, bankers say to regulators, look, you guys stop making us have 25% of our notional amount of money that we're lending out. Stop making us keep that in our actual basement. The temptation is just to keep lending more and more money and assume that no one's actually going to come and demand their savings back. And that's a risk that the banks take. Sure, in boom times when banks are doing well, there's always pressure on regulators to try and relax the rules. And you can see that in America, for example, during the first Trump administration. There was a desire to roll back some of the banking reforms imposed after the 2008 crisis. Likewise, in the UK, there's a lot of talk about Big Bang 2. And if that involves too much deregulation in the banking sector, some of the risks which were exposed in the 2008 crisis, well, they might just come back. However, the problem is that the regulators don't have all the answers to a banking crisis. So because of the nature of the 2008 crisis, they very much now focus on liquidity risk and also the risk of not having enough equity buffers. But as the collapse of the Silicon Valley Bank has recently shown, those are not the only thing that the bank actually has to be worried about. So getting back to basics, it's the early Italian bankers who would declare bankruptcy first, and what they would do is then smash up their market stalls and walk away. To the 18th and 19th century banks in the UK, who actually seemed to go bankrupt a lot, there were lots of banking failures in the past. And that was just because lots of savers were turning up at the same time and saying, we want our savings right now. And the bank couldn't make that work. So is that because it loaned money out and it couldn't get that money back in quick enough? Yes. So in the mid-19th century, certainly in Britain, there were frequent banking panics, banking crises, bank runs, whatever you want to call them. Everybody effectively running to the bank and demanding their money back. And there were banking crises in Britain in 1825, in 1837, in 1839, 1847, and 1857, and then in 1866. There was at least a banking collapse once a decade. And you can see very easily that there's a cycle going on there. And that cycle actually continued in other countries until the present day. But in Britain, for literally the last 100 years, banking crises disappeared, certainly between 1866 to 1973. And it's not that banks disappeared, because banks were actually very important, but banking crises almost completely disappeared. So much so that in a 1960s film, actually, it was in the original Mary Poppins movie. There's a scene about a bank run on an Edwardian British bank. And I don't know whether you remember this, but someone overhears that the bank is not going to give 2 pennies back to one of the children of the family that Mary Poppins works for. And the depositors on the floor start to hear that. And then they go, well, if the banks aren't giving that person their 2 pence back, what the heck's happening to my money? Well, I'm now worried that I'm not going to get my money back, so I want all my money back. And of course, what that does in the Mary Poppins film is start a run on the bank. And in simple terms, that's how runs on banks have happened in the past. But of course, that was a fantasy scene. And it was a fantasy scene because in the 1960s, this hadn't happened in Britain for 100 years. That scene is actually just meant to be as fantastical as the Mary Poppins movie. And that's the point of it. That's the point that the directors were making. However, we've seen crises reappear in British history since the 1970s. So in the past, they were very common. Some countries did get rid of them for quite a significant amount of time, but weaknesses in the banking sector, the financial crisis, appear to be coming back, particularly in Britain's financial sector. And of course, when Britain sneezes, the world gets a cold. So the question begs, why did Britain manage to put its turbulent 19th century banking history behind it? What actually happened? And I think the answer to that question is partly, why were there so many crises in the middle of the 19th century in the first place? And that in part is because the central banks and the banks did not understand interest rate risk. As simple as that. So the Bank of England used to keep interest rates as low as possible for as long as it possibly could. And then when a crisis appeared, or what would trigger the crisis, is when the Bank of England suddenly had to raise rates in order to stop running out of reserves or keep within, its own regulations. The Bank of England's lending rate would hit a record level. And this actually occurred in 1847 and 1857 and 1866 when, new highs were achieved. And then after the crisis, they would put interest rates back down to a very low level. And just as the collapse of Silicon Valley Bank has shown, rapid rises in interest rates can make banking systems very, very unstable. And the question is that because much of what the bank has invested in with our money are low-yielding bonds? Things like that, instruments from a previous era, from a time when interest rates were very low. So those things aren't very valuable at the time when interest rates are quite high. So is it that the bank is unable to meet its obligations to its investors, or that the people just want to get their money out? Absolutely. The bank either goes insolvent, or even before it goes insolvent, the fear that it could become insolvent is enough to trigger a bank run, which causes it to run out of money at hand. So it becomes illiquid, or it might cause it to fire sell its assets. And that might make the value of its assets go down even further. So it becomes insolvent. And that, ladies and gentlemen, is exactly what happened to Silicon Valley Bank. It announced that it had to fill a hole in its balance sheet, and that was enough to trigger the fastest bank run in world history on some metrics. And they admitted it. They said that we need $2 billion because we've got a bit of a hole in our balance sheet. I mean, $2 billion, it may be a bit of a hole for some people, but that's a massive cavern for everybody else. But they then said, but don't worry, it'll be fine. And by the way, can everyone please buy shares up to the value of $2 billion? And everybody in their right mind went, no, we want our money back, and we want our money back now. And effectively, we're going to sit outside your bank branch with a big sack to put our money in it as soon as possible. And, of course, what we're seeing there is actually very old. It's a classic case of a 19th century bank run following an interest rate hike. And let's just take a short break for a message from our sponsor. Autonomous is your one-stop shop for your Malaysia My Second Home visa. But they are much more than that. When you sign up with Autonomous, you become part of a larger community, a community that cares about you in Malaysia. And that's important when you move to a new home. So for more information, call Autonomous or WhatsApp them on +60 12 493 7270 or visit their website www.penangmyhome.com. And we are back. And look, I'll be perfectly honest with you. I'm very unhappy when a banking collapse happens. I think it's a great failure both for our policymakers and people involved in public discourse such as myself, because these are avoidable and they are preventable. And they were caused very much by the same factors as previous banking crises were. And indeed, in Britain basically got rid of systematic banking crises for over a century of its history. So it can be done, and it should be possible to do exactly that again in the future. And of course, one of the ways of doing it, as we saw in the legislation that followed the 2008 crisis, which was then kind of watered down by Trump and the Republicans in his first term of office, is as well as the various tests around with regard to how much money you're holding, the ratios and things, you can also check a bank's exposure to interest rate rises. And we should all be talking about that. I think the regulations brought in after 2008 are very important in so much that regulators can't produce the entire solution. Regulators are always like generals who are fighting the last war, not the war that's about to come. And on some of the metrics which came under scrutiny in the 2008 crisis, Silicon Valley Bank, it actually wasn't doing that badly. It hadn't bought a load of rubbish assets. It bought US government debt. But what had been ignored in that regulatory push since 2008 was interest rate risk. Simple as that. What if interest rates suddenly rise? What if short-term lending rates suddenly rose above long-term lending rates, which has occurred actually in the past few months? Essentially, Silicon Valley Bank was borrowing short-term, using short-term interest rates and lending it long-term, as in buying this US government debt. And the point is, interest rate rises make the price of bonds fall. So the yield or the interest rate moves inversely to the price of a bond. And long-dated bonds are particularly sensitive to that because, a lot of the price of a bond is very strongly related to the current interest rate. So the interest rate rises made it more difficult for, or more expensive for, Silicon Valley Bank to track funds. And at the same time as interest rate rises were making the value of what it bought, what it had invested in fall, essentially that's what made it collapse. But looking at the risks associated with that is not how regulators have been looking at it. And that's the problem. And also, central bankers are far more interested in looking at how much monetary policy impacts inflation. And that's a very important thing that I guess they've kind of forgot to consider. What's the impact of monetary policy on financial stability? And what are the consequences of monetary policy for financial stability and potential financial crises in the future? And of course, the thing that everybody wants to avoid at all costs are banking failures or banking collapses. Banking collapses or recessions, which are associated with banking collapses and banking panics, they actually produce much worse consequences than recessions which don't have banking collapses. So, for example, the recession which didn't have a banking collapse is in the early 1990s in Britain. And an example of one where there was one was in 2008. In the early 1990s, the economy bounded back and continued its previous growth path really, really quickly. The economy actually dipped and then woof, it was back really, really quickly. If you compare that to 2008, what happened was the British economy shrank and then it just stopped growing. And of course, the last 15 years have been the worst 15 years in UK economic history for growth, in the last 200 years. And you actually have to go back to the 18th century to find a period that was so bad. And that's the effect of having a banking crisis, because banks, if there's a banking crisis, banks run into problems or they just completely disappear. And that's akin to the financial system having a major heart attack. So what happens then is you stop getting savings being converted to investments. The economy shrinks and grows a lot less. And therefore, in a recession where you have a banking collapse or banking panic, recessions are longer, recessions are deeper, and recovery takes longer to happen. And you know what? It's much slower when it does happen. And economists think that half, if not more than half of the blame for basically having no growth in Britain since 2008 can actually be attributed to the fact that there was a banking panic, a banking collapse in 2008. So this is something you want to avoid at all costs. And there's also a political problem as well, in addition, in that people don't like slow growth. If there's a period of short-term downturn, voters tend to be quite forgiving of the politicians, that being the case. However, if they've come to a long drawn-out thing, people get really frustrated. And they try to vent that frustration by voting for extremist parties. And as several economic historians before have found, banking collapses have seen an increase in extremist voting. And that's what's happening now. And I think the correlation is plain to see. And I think you can quite clearly see that across the world, literally since 2008. Trump was the first in America in 2016. And of course, then what we've seen since then is the rise of the far right in Europe and in Britain, the rise of the United Kingdom Independence Party. And look, it's as frustrating as hell. These banks, we talk about heart attacks, we talk about suicides. Banks are essential to our lives, our economy, and the future of liberal democracy. And bankers, in my experience, can be pretty detached guys who get paid multi-million-dollar bonuses when their banks collapse. The Silicon Valley Bank CEO, I was floored. I fell off my chair when I found this out, was paid close to $10 million on the collapse of that bank. So the question that I have is, why is the future of our civilization in the hands of people who really don't give a damn? And that to me seems inherently incredibly dangerous. But politicians have even greater power in their hands. Politicians can't say there will be growth, but they can destroy an economy quite quickly and cause financial panic very quickly. But I think the way to think about this is that the financial sector, just like any other sector, it needs proper regulation. Partly that regulation is to make sure they preserve good enough equity buffers. But I think it's also important that the macroeconomic environment actually remains stable for bankers to make sensible bloody decisions. So rather than having very low rates followed by a sudden rapid rise to record new rates, and then going back to low rates for a decade, and then, suddenly having very high rates, why not make the adjustment smoother in the interest rate market? So instead of these rapid rises and falls, lots of small adjustments to interest rates, which aren't so quick, so prompt, but not necessarily the rapid changes that we see because the politicians think it's going to make an immediate difference. And get this, that's actually how banking crises disappeared in Britain in the late 19th century. There was a change in interest rate policy and a change in monetary policy at the Bank of England. And those lessons have actually more or less just been thrown away in the last 50 years, which is why banking crises have returned in world history with a vengeance. Look, it might be frustrating, but we've handed all this power to bankers. But that's why we need to regulate the banking sector properly, as well as produce these macroeconomic environments which actually help banks work properly and help give banks the incentive to focus on really their key role in the economy, which is to help recycling savings into investments. It's that simple, guys. So there's many things wrong with the structure of the world's banking systems, in that banks use far too much of those savings that depositors are leaving with them on giving loans to buy very, sometimes quite artificially inflated house prices, as an example. And in reality, what we want is growth. That money shouldn't be going into mortgages to push up housing prices even higher and higher. Instead, more of that money should actually be going and being invested in the domestic industry of the country that the bank is domiciled in. Stop going offshore. Invest domestically. Likewise, the decline of the world stock markets are partially because domestic investors no longer want to invest in their own domestic companies. They want to use their money to buy stocks in other countries or cryptocurrency. And the result of that is that the bankers now joke that domestic shareholders and their domestic stock markets investors are some of the people who least want to buy their own domestic investments. So something's gone wrong, structurally gone wrong in the domestic banking system, in that this is no longer really a banking system which takes, deposits from domestic investors and recycles that into investment into your home country, in firms and companies in your home country. And this has been something which has been decades in the making. But to be fair, there has been a profound shift in what the City of London does, the City of Paris does, and what New York does, what Tokyo does. And the question mark is, are the bankers in those cities doing the best job they can for their domestic economies and the long-run economic growth? That's a really heavy question. And I think it's a really big question that politicians and regulators and central bankers need to think about very seriously over the next decade. So why are bank crashes contagious? Is it because when the first one or two crashes, that is indicative of a very kind of challenging environment for the banks and everybody recognizes that? Or is it sentiment? Everyone starts panicking. I guess it's human nature. When a regional bank goes down, we all start wondering about our banks, no matter where we are in the world. So the initial banks in the banking crisis had problems, but it could be because they hadn't got enough in terms of equity buffers. It might be because interest rates make them fall over, but then that damages sentiment, right? And then you get an extreme scenario of everyone runs on every bank and everybody wants their money out. And of course, then the system becomes unstable. And they're exactly the reasons why we want to prevent banking crises. And this is why policymakers need to spend a lot more time thinking about how to prevent financial collapses. Because the other problem is when a bank collapses, what do? So if you bail out the bank, if the US government, for example, were to protect the deposits of, say, Silicon Valley Bank, if you do that, it produces something that economists call moral hazards. So if the bank thinks, oh, well, we'll just go bust if we collapse, the government will step in and just bail out our depositors, the bank will start taking very risky steps and making very risky decisions because it will go, well, you know what? We can actually keep the profits when the times are good. But somebody else will pay for our losses. The taxpayer will pay the losses when things go wrong. And you don't want to incentivize that sort of behavior. So the best thing to do is to ensure that crises don't happen in the first place so that you don't get the first banking collapse, which sets off the line of dominoes, which causes a much bigger banking panic. And the way you do that partly is through good regulation. And I keep going back to it. It's just good regulation. And I put my emphasis on good quality. So it's not the quantity. It's not how big the rule book is, but whether it's really dealing with risks in the system and also creating a stable macroeconomic environment. So the central bankers need to understand the impact of monetary policy changes, the impact of interest rate changes, and on the stability of the financial system. They have to understand all of that better. That's why it's important to both prevent the first banking collapses, which might trigger panic and can cause a wider banking failure. But it's also important that we try to prevent that before we get to that situation, even before the first few banks fall, before the first domino in that sequence is actually touched. And creating that moral habit is actually difficult because then people know that they can behave however they like and someone will actually step in and bail them out. And that's actually infuriating to voters. And this is why the politicians should be taking notice, because then you are caught in greater danger of merely exacerbating that problem, postponing it really rather than dealing with it. I mean, that's essentially how policymakers in Lake Victoria, Britain were thinking. Walter Badgott is famous for arguing that the Bank of England should become a lender of last resort, but it should be the lender of last resort only to the banking sector, but only a penalty of interest rates, charging high interest rates in order to punish banks for being impudent. But he actually thought, okay, this is what you do when you're in a mess. But he also thought that there are things that the Bank of England should be doing when the times are good in order to make it less likely that you get a banking collapse in the first place. And these things are actually pretty simple. Regulators take note. They are greater reserves, but also a more stable monetary policy system and a more stable macroeconomic environment. That's what he really thought would reduce the propensity of the banking collapse, which could trigger a full-blown banking panic and banking crisis to occur. And the people have taken the lender of the last resort out of his thinking, which is okay, if you're in a terrible situation, this is what you do, but not really looked at what he was thinking about how to prevent crises. And that's the sort of thinking that I'm trying to highlight and promote in this podcast. We should be thinking about how to prevent crises in the future by creating a more macroeconomically stable environment and a regulatory system which focuses more squarely on the risks that the banking sector faces, including interest rate risk. Those of you who want to read a more in-depth kind of study about this, there's a really, really good book titled Calming the Storms, subtitled The Carry Trade, the Banking School, and British Financial Crises Since 1825. And I know what you're thinking. It's a great book for insomniacs, but it's really not. It's by a guy called Charles Reed. It's a fabulous book. And basically the book explains why there were so many crises in Victorian Britain, and then explains how those crises disappeared for a century, and then why they've come back in the 1970s. It's a goodie. It's actually a really, really interesting book, and definitely not for insomniacs. Folks, thanks for tuning in. I hope you enjoyed the podcast, and I'll talk to you again next week. Bye for now.